Welcome, everybody. We're excited to welcome you to our presentation, Market Outlook Veterinary Service for Q2 of 2024. For those of you who have not attended before, these slides will be completely new. If you have attended before, it'll be a good reminder of who the Ackerman Group is. So I'm just going to walk through a couple of slides and then we'll let Rich take over. So.
All right, and as always,
my
ability to move the slides seems to be, there we go.
There we go. Just a couple of housekeeping things before we begin. If you have questions, and I hope you, we certainly encourage questions. There should be a Q&A box at the bottom of your screen. Go ahead and type any questions you have into the Q&A box. Rich will endeavor to answer some if he sees them throughout the presentation, but definitely we will get to them all at the end if we don't get to them throughout. And if you had a private question or you wanted a private consultation with Rich, he's also going to be inserting his Calendly link into the chat box, so you can use that to schedule a meeting with him. So who is the Ackerman Group? The Ackerman Group is the largest brokerage firm of veterinary practices across North America. And I can say North America now because we've recently entered Canada, not Mexico, mind you. We've done over $2 billion worth of transactions over the last 7 years. We've sold approximately 200 practices, probably a little bit more now. We've been averaging approximately one sale per week, which is shows you how regularly we've been closing deals and how in touch the Ackerman Group is with the market. We do all kinds of advising. We have relationships with all the buyers across North America. We do joint ventures, 100% purchases. We've dealt with private equity firms as well, so a vast amount of knowledge. This is our team. One addition, obviously, with a little Canadian flag beside it is me. The rest of the team is super impressive. They've been with the group for a number of years. We've got our sales advisor team, of course, led by Rich. We've got our financial analysis team that does the valuations and works on analyzing the practices. Our operations team helps gather due diligence and prepares the sales documents, and of course our amazing marketing team and our founder, Dr. Gary Ackerman. So one of the things that really separates the Ackerman Group is, we find buyers who are the best fit at the best price and the best terms. We bring it all together for a transaction that means that you found the right buyer and the buyers have found the right practice. And when we do that, we know that it's going to be a great fit and a great partnership going forward. Now, just to introduce our presenter, our CEO, Rich Lester. Rich has a lot of industry experience as well as years of financial and acquisition experience across his career, starting at DaVita, went to Bear Stearns. He was the founder and CEO of a veterinary chain called Veterinary Practice Partners for a number of years. He grew it from no practices up to 65, I believe, Rich. Yeah. And 2 or 3 years ago became the CEO of the Ackerman Group, and has really led us to the next level of advisory services. So I'd like to turn it over to Rich now, and as I said, please feel free to ask any questions along the way.
Thanks, Mike. And we are especially excited to have Mike join the Ackerman Group. He's based up in Canada, in the Toronto area. He's worked in the veterinary industry for a lot of years, in particular up in Canada. So we're excited to expand our services up north. And I'm going to start today just with an overall, the economy. The presentation today is going to sort of come in 4 parts. We're going to talk first about the economy, what's happening with the economy, I'll then move to how the economy is impacting the veterinary market itself, where we've seen sort of sluggish invoice growth, but rising multiples for practices despite the sluggish invoice growth. And I think some of the more interesting stuff to start hypothesizing about is what November's election may or may not do to the economy, and public policy and policies that presidential administrations implement do impact the economy, and that does trickle down to the veterinary market. And so we'll walk through a little bit of that. And then finally, I'll close with sort of what do you in the audience who are individual practice owners, what should you be thinking about in terms of timing of selling, getting advice, and things of that sort. So we'll start with the economy, and the two key pieces to the economy have been growth and inflation, and obviously interest rates are the other big factor that have been really driving what's going on in the US economy. And so I have just two graphs to sort of walk through today. And the first is something that I've shown the last number of presentations, which is what's happening with inflation and what's happening with interest rates. So the dark blue line here is the Fed funds rate, or how much, where are interest rates set by the Federal Reserve. And the light blue line is what's going on with inflation. And a couple of things to think about is in the 2021-22 timeframe, inflation started going through the roof. And that was driven by two basic things. One, a ton of money was put into the system through COVID fiscal policy that the Trump and Biden administrations had rescue packages to get money to people. Veterinary practices got PPP loans, individuals got checks. That money was being spent. And then you combine that money that the government put into the system with a supply chain shortage where we couldn't get goods from China. That led to rising prices. The problem was the Federal Reserve was a little bit slow to react, and it took until the interest rate inflation was up to 8-9% before the Fed started to dramatically raise rates. And once they raised rates, the desired impact happened, i.e., inflation started to come down. And we've reached this sort of, equilibrium over the last almost year, where interest rates have been steady at around 5.25%. And inflation's hovered between sort of 3 and 3.5%. And as long as inflation isn't dipping lower, the Fed has maintained the high interest rates. And there's some belief that inflation will start to dip below 3%. And hopefully in September, the Fed will lower rates a bit. But at the beginning of this year, in December, January, there was a view that the Fed would lower rates 2, 3, 4 times this year. It's likely going to happen once. And so that once is because, one, inflation has stayed a little higher than everyone thought. And part of why it stayed high is because economic growth and the job market both remain strong. And so this chart is showing GDP growth in the dark blue, and GDP is gross domestic product, which is a measure of sort of how much is our economy growing. And then the light blue is interest rates. And so typically when you take interest rates up, gross domestic product or economic activity declines. The problem has been, or the reason that rates haven't come down, is you can see economic activity has been pretty strong. There was a dip in Q1, but Q2 was back to almost 3%, 2.8% economic growth in the second quarter. And so the likelihood of quick interest rate cuts is really reliant on the 1, inflation, 2, economic growth, and 3, the job market. And all 3 of those things have been relatively stable despite the high interest rates. So our view is that it's going to take some time for rates to come down. And the higher the rates are, the harder it is for the buyer of veterinary practices to sell their own businesses to other investors. And I'll talk further about the recap market in a few minutes. But the higher interest rates really do impact the veterinary market. In particular, the buyers of practices borrow lots of money, And the higher the interest rates are, the more money they're spending on interest instead of paying you more for your practice. So what's happened to the veterinary services market and how is it evolving? So I've been showing this slide probably for the last year to 18 months because back in 21, waiting rooms were jam-packed. It was hard to get appointments. And in the last really 2.5 years, waiting rooms have been less crowded. Invoice growth has been much slower. And there's a bunch of reasons for that. So this is the data. We get this from IDEX, which publishes the data every quarter. If you look at the dark blue line, which is revenue growth, and then the light blue line is invoice growth, this chart starts back in 2018, but if you went back to 2012, you'd see that for 7, 8, 9 years, revenue growth was really steady between 4 to 6%. Invoice growth was really steady between 0.5% and 1.5%. And we had a really stable industry. Then COVID showed up and boom, invoices plummeted during the time when we were all sheltering in place. That was followed by huge invoice and huge revenue growth in 21 that was sort of not sustainable. And over the last now 2.5 years, basically, since the beginning of since Q1 of 2022, we've seen negative invoice growth, meaning invoices have shrunk quarter over quarter now for 9 quarters, and IDEX will release more data early next week, and we expect it to be a 10th straight quarter of invoice growth declines. And that's, again, unprecedented for the industry. The only silver lining is it helps with the crazy labor shortages that everyone has. If invoices were growing really fast still, it would impact the labor market even more, so it's allowing some catch up there. But the reasons for invoice growth slowing the way it is multiple. One, the COVID adoptions are now no longer puppies, so there's less visits as the dogs that were adopted become 2, 3, 4 years old. The second reason is that there's been a lot of price increases that everyone's taken, so a number of pet owners are frustrated by price and come in less often. And there's likely other reasons for the slowing invoice growth, but it's a real impact on the industry. And we think by the end of this year or early next that we'll start to regress back to the mean and we'll start to see some invoice growth. But it's been a slow period for the industry. But what's actually interesting is, despite the slow invoice growth, purchase price multiples that are being paid for practices actually seem to be heading back up again. And so this slide, if you see the peak that happened in 2021, it sort of coincides with the peak in revenue and invoice growth. So there is correlation between what's going on sort of with revenue and invoice growth and what prices people will pay for individual practices. And so this is a data set that is unique to the Ackerman Group. This is all the deals that we've worked on, about 45 a year on average. And it shows the average multiple that we're selling clinics at. And it peaked in the second half of 21 at sort of on average 16 times profit or 16 times EBITDA. For about 18 months from the second half of 22 through all of 23, the average multiple was sort of 11 times, and the range was 8 to 13 times profit or EBITDA. And we're now starting to see the multiples tick up in the first half of 24, and we expect that rise to potentially continue. And what we're seeing is sort of a bifurcation in the market where the demand for the higher end practices, which we define as $500,000 of profit or more and 4 or more doctors, the prices for those have moved from 13 to 14, 14 and a half, taking the average multiples up. The valuations on the 2, 3 doctor practices that are doing 300, 400,000 of profit have remained relatively steady in the 8 to 11, 8 to 12, depending on the market. And so bottom line is the market continues to be strong. The average practices are doing fine. The higher end practices are doing great. Partly why the higher end practices are doing great is that the barriers to entry or the ability for a new buying group to form are actually pretty low. And we're seeing new buyers enter the market all the time. So this chart, the key on this chart is that the dark blue is a new buyer that we are working with. And the light blue are buyers that we have worked with in the past. And so what we've seen that's sort of amazing to us is we've been very active as a broker, and we saw, in 2020, 11 new buyers, but in 21 and 22, only 2 new buyers. But last year we had a spike and saw 7 new buyers working with us. This year we've already had 2 new buyers and we have LOIs with 2 others. And so what that's telling us, and it's important for you if you're thinking to sell, new groups are forming all the time. And those new groups are many times willing to pay money to get new practices into their growing organization. And there are names that you may never have heard of and may, if you sell the practice yourself, never think to utilize. And so understanding what's going on in the market, critical. And a lot of the buyers that we saw in 2020 and 21 buying lots of practices are now regrouping and not spending time buying practices or trying to manage their existing practices and get their operating teams together. And so the buyers shift over time. It's really important to know. And then this is a new slide with some new data that, again, comes from our comprehensive database that we're tracking. And we, with every practice that we bring to market, we not only track who wins the bid, but we also track who is bidding on the practice. And what this data here on the right is each group is a different buyer. And then we look at how often a buyer wins and then what type of practice they win. Is it a smaller practice in a not in a secondary market, or is it a really highly competitive practice sale process in Atlanta or Charlotte with high growth? And so by tracking this data, we know who the logical buyers are for most every practice, or we know the 2 to 3 or the 4 to 5 most likely buyers when we bring a practice to market. And by the way, those names shift year to year because buying patterns change. But our data set's really helping us service our clients and make sure we, as Mike talked about at the beginning, find the best fit at the best price and on the best terms, because we know who to go to for each deal. So we talked about higher interest rates over the last 18 months. What has that done to how deals are getting done in the veterinary space? And there have been, I'd say, 3 things that we wanted to highlight. One is deals are seeing people are using less cash and more structure for deals, and they're doing that to de-risk the deal. And the less cash today means buyers are typically paying 50 to 75% of the purchase price up front. And then the other 25 to 50% of the purchase price is in delayed gratification, delayed cash to you that is done through different structures. And the 3 or 4 most common structures that we see are, one, what we call top co-equity, where you take equity in the parent company of the buyer. And we describe that as when you take top co-equity, you're betting on the management team that is buying your business as opposed to betting on yourself, because you're going to become one of 50, one of 100 hospitals, and you're counting on that management team and those investors to make that top co-equity valuable. Your ability to impact it is a little bit, but not huge. The other type of structure we see are joint ventures. And that we typically say is when you want to bet on yourself and not necessarily bet on the buyer or the management team. When you do a joint venture, you're retaining ownership in your existing clinic or clinics, and you become partners with a buyer. And that buyer has a lot of influence on your clinic. But if you can maintain your culture, maintain your doctors, you can usually grow that joint venture and create a lot of incremental value through that structure over a number of years. The third structure that we see a lot of are contingent notes, which are basically you take back paper from the buyer, and they will pay you that loan over time. A lot of times they're contingent on you staying employed, revenues hitting a certain threshold, and that's why they're contingent. Sellers typically prefer cash, but the best sellers can get more cash, but a lot of times you're taking 60, 50% cash up front because that's what the market is doing right now. And the buyers are offering less cash because they're paying higher interest rates. So that's one big deal structure trend, is this more structure. The second big trend is that the associates at your practice are more important than ever, and retention of them is crucial. And retention incentives for associates are happening in virtually every deal. If you're a big producing doctor, you're likely going to be asked to stay for 3 years or more as a seller, as an owner and seller. We're also seeing associates becoming more and more aggressive in their asks for, hey, if you want me to sign up with Corporation A, I need X as a retention bonus. And so it's really important to have skilled advice to help you navigate how to manage the associates and the retention bonus processes. And then finally, the third trend, which I've talked about already, the strongest practices, 500,000 or more of EBITDA, 4+ doctors, getting tons of interest from buyers. So what do we see happening the rest of 24 and into 25? Right now the economy is stabilized, inflation's flattened. We don't think that there'll be any major changes until post-election. Interest rates might go down a tiny bit, but once the election's over, I think there's a lot of risk that gets inserted into the economy. And I'll explain that in a minute. Valuations are looking good right now, despite the higher interest rates. And so from an overall economy standpoint, it's probably a pretty good time to be thinking about transitions. What do we think about the buyers and what's going on with the buyer market? So I mentioned this recap market, or when you sell a practice to one of these corporations, they're owned by an investment group, and those investment groups typically want to sell out every 4 to 6 years. Over the last 2 years, that market for selling has been pretty dormant because of the high interest rates. And so there have been very few to no there've been no transactions amongst the larger companies. Amongst the smaller companies where less debt is used, there have been a handful of transactions. We expect the first big sort of large recap happening in the first quarter of 25, despite the higher where interest rates are. And we think that the owners of these practices are getting a bit frustrated. They've been waiting for 24 months, and it's going to be 30 months by the end of the year. And some of them are going to just start to sell despite the higher interest rates because they want to liquidate and get money back to their investors. So as these larger groups are looking to do their recaps, they need to show strong pipelines of individual deals for the next buyer. And that is what's helping drive the competition for deals, and especially for the best practices, the 500,000 of EBITDA or more and more groups are looking at those. And as I've said, the spread between the top practices and the average practices are widening, but there's still plenty of buyers for the 1.5 to 2.5 doctor practices. As I showed, we know who those are and who's likely to bid. And then from a seller's perspective, what are the trends that we're seeing? In 22 and 23, we saw sort of a decline in quality of practices that we were bringing to market, meaning there were fewer A-type practices with 500,000 or more of EBITDA that we were bringing to market. And we felt like that was because the larger practice owners were kicking themselves for missing these high multiples in 2021. They were waiting to see if it was going to return to those frothy days, and it hasn't happened. And so we're now starting to see sellers think about selling it when it's right for them. And so we're seeing an increase in quality of deals in 24, and we've got a nice pipeline of good practices that we're bringing to market. So now we've talked about the economy, we've talked about our industry. What do we think about with the November election? And I'm not going to sit here and prognosticate who's going to win. And I'm also not going to talk about what my political views are. What I'm going to try to do is take a layer of what are the policies that the Democrats and the Republicans are each talking about implementing, and how do those policies impact the economy, and in particular, inflation and the likelihood of a interest rate decline. Because there'll probably be when I've looked at this, I was very surprised at sort of what the policies might or might not do. And there's going to be a lot of focus on Kamala and Donald Trump over the next 3 months as this election heats up. And so I'm going to first take a look at Republican policies and the things that Trump has talked about pretty extensively. I'm going to start at the bottom. So curtailing government regulations, which is a big, big initiative that he started in his first administration and feels like he was blocked, and there's a lot of prep going on for more of that to happen. And that is actually pretty good for the economy. It will decrease the cost of doing business. It may not make lawyers so happy because there'll be less work with the government for lawyers, but we think that less government regulation should help with disposable income from the veterinary market perspective, so people will visit the vet incrementally more because of that policy. But if you look at the rest of the policies that he's talking about, many of them are sort of, to be frank, inflationary and might keep rates high. So the first two at the top of the list are the most important ones. There's a lot of talk about going back to a bit of a trade war with China, increasing tariffs. And as soon as you put tariffs on things, the cost of goods goes up, and that takes pricing up. And if pricing goes up, that leads to inflation. We've seen that inflation will lead to typically decrease in visits, decrease in purchase price multiples. The second big policy that the Republicans are talking about is a real focus on deportations and not allowing illegal aliens in, and really focused on immigration. And the reality is we have a real labor shortage in this country. Unemployment's only 4.1%. And if you talk to employers trying to find $15 and $18 an hour folks, it's super hard to find low wage workers. And so deporting or clamping down on immigration is going to likely raise labor costs, and we saw what higher labor costs did during COVID. It leads to higher prices, it leads to inflation, which leads to some of the problems we've seen. And so the final policies that I think are important is there's a lot of talk about tax cuts, which would be great to put more money in all of our pocketbooks. But unless there's massive changes in government spending, it's going to increase budget deficits, which over time will eventually lead to higher interest rates. And so my comment is, overall, typically people view Republicans as the better stewards of the economy and more business friendly. But if business friendly means lower inflation, lower interest rates, unclear to me that the Republican policies will drive that. From a Democratic standpoint, Kamala hasn't really defined fully what she's doing, what her core policies will be. We've sort of looked at what Biden has been doing, and I think overall he's had less restrictive immigration, which has given us at least a little bit bigger of a labor pool, and we're still struggling to find workers. But on the flip side, there's been massive government spending over the last 3 years. The last COVID stimulus bill, the infrastructure bill. We haven't done anything to increase revenue coming into the government, so deficits are gone through the roof. And that is helping with drive the inflation a little bit, helping drive interest rates. And so there's no right or wrong answer. The reason I highlight this stuff is I feel like economists talk a lot about an inevitable decrease in interest rates starting in September, October of 24 and moving into 25. I'm more skeptical about the trend into 25 of lower interest rates, because I think a new administration is going to go aggressively after a lot of their primary objectives, and a lot of the objectives don't seem to be things that will keep inflation under control. So I'll take questions on this stuff in a few minutes, but we think that the likeliest outcome of the election is more economic uncertainty. And I wouldn't be thinking, hey, rates are going to automatically decline in 25. It could happen, but there's just as much risk that it won't happen. So a lot of information as an individual practice owner, what should you be thinking about? So Gary Ackerman, founder of Ackerman Group, put together this very simple framework that I really like. When you think about selling your practice, there are three important pieces to think about, which are the three legs to the stool. One is what's going on in the market. Two, how are you doing individually, and are you ready to sell and lose control and work for someone for a couple of years? And three, how is the practice performing? And is the practice in good shape, bad shape, or somewhere in between? And we always say when all three legs of the stool align, to sell. I would say that today the market is in really good shape. So it's a good time market-wise. You've got to assess yourself and assess your practice. A lot of people at 58 and 60 years old say, hey, my practice is running really well. I'm going to keep waiting to sell because it's going well. I would argue at a certain point in time, you should start selling when the practice is running well so you can maximize value and you can begin the clock ticking for when you will have the optionality to retire. Because when you start a sale process, it's not like when it's over, you can retire. If you're a producing doctor, you've got 3+ years to work. And so we always talk to our clients about creating optionality for retirement 3 to 4 years after you sell. So depending on who you are, what your practice looks like, our advice differs. If you're 60+ year old owner and you want the option to retire, we think you should be looking at selling right away. Just the older you get, the harder it is to get full value for your production. If you're a big producer and you're 68 years old, you're going to get a discount because not everyone's going to believe you'll keep going for 3+ years. And remember that, as I just said, the sale process from start of the process till your end of your work requirement is typically 3.5 years. If you're not looking to retire for 4+ years and you're under 60 years old, you may want to wait. You may want to wait till rates decline. You may be waiting a while. We're not totally sure. And we're happy to talk to you about what all that looks like. A+ practices, the 500,000 or more of EBITDA, you're going to get lots of offers. Valuations will be 12 to 14x. Now's a very good time to sell. If you want to wait a little bit, that's fine too. If you're 40 years old with that type of practice, you can wait a long time. For the hard to recruit markets, we would argue you should really start looking sooner, not later. If you're in a secondary or a tertiary market where it's hard to recruit and you're a big producing doctor, a lot of groups are going to want you to stay not 3, but 4 to 5 years because it's just hard to recruit in Iowa, in Nebraska, in Oklahoma. And so hard to recruit markets, really important to be planning even further in advance. So we also say that given the market's complexity, good advice is more valuable than ever. Market knowledge is key. If you go back to the slide where I was showing all the new buyers that have entered the market, knowing who those buyers are and who's aggressive at this moment is really important. A handful of buyers have let go some of their acquisition teams. Some of those people are becoming brokers and advisors. You know, I always tell folks, the biggest gift you can give a buyer is to sell the business yourself and be a DIY buyer. Most individual veterinarians think they know a fair amount, but you know a lot about practicing medicine. Selling a practice is a once-in-a-lifetime experience. Get good advice. We think we give the best advice, but get some advice if you don't want to use us. The probability of closing deals has also changed over the last 2 to 3 years. Buyers are retrading terms. The length of time to get a deal closed has moved from 60 to 90 days to 75 to 135 days. Buyers are spending more time analyzing every last piece of data and having a good advisor help you navigate that, really important. And then the other piece, lots of companies are offering what we call this top co-equity. There's lots of questions that should be asked to help you evaluate, is the value of that top co-equity appropriate? Is one group's top co-equity better than another? What are the terms of that top co-equity? Very complex, along with JV terms and other things. So because of the complexity, it's important to get good advice. And we put this slide after the get good advice slide to let you understand a little bit about what the buyers have behind them. And, it should make you a little bit nervous because they've got a lot of talent trying to figure out how to buy hospitals at attractive prices and not give you the best deal. So when you're looking to sell your practice, and anyone with a decent sized practice has had business development reps from various companies call on them. And those people's job is to be nice, friendly, and for you to like them. If you don't like a business development person, they're not doing a good job. They probably won't stay in the role a long time. Their job is to be friendly and to sell to you. And they're the face that you see, and they're really nice people, and they're, convincing you to work with them. But behind them, there's a group of financial analysts. There's a bunch of really smart lawyers. There's a senior management team of business executives who've spent years working on deals. And then they report to a bunch of private equity executives who spend their lives trying to maximize returns for their investors. And so you've got this whole team of people trying to figure out your deal. And if you have your local or personal attorney working with you, and it's just you, the odds are stacked against you. As Mike said in the intro, I spent 10 years on the buy side working and building VPP. I had this entire team behind me. Most of the groups that we worked with, brokers weren't very big back in 2011, 12, 13, 15, when I was building the business. And so, our partners have all done well at VPP, but I would say they would have gotten better deals if I was on the other side of the table helping them negotiate the deals, because I understand what to look for. So we always say, again, if you're going to sell, get good advice and get some help. Last but not least, I'm going to make a little plug for we last year started an owners only conference called insightful.vet. We did that conference in October of 23. In late September of 24, we're doing the second V 2.0 of Insightful. It will be in Philadelphia. We have great speakers, great food. It's a 2-day conference. It is 60 to 70% about how to better run your practice. We give very specific tactics and advice on how to better run that practice, both from a marketing, revenue growth, cost management, negotiating doctor contracts, recruiting, all aspects of running the practice. And then 30 to 40% of the content is about stuff like I'm talking about tonight, how deals are structured, what to do with your real estate, and things of that sort. So if anyone has time, September 26th to 28th, we'd love to see you at the conference in Philly. And now I'm going to take a pause. We're about 40 minutes in, and I'm going to start doing some Q of A, meaning questions and answers. So if you have questions, click on at the bottom of your screen, you'll see a participants, a chat, a Q&A, a share. Click on the Q&A thing and start typing questions into the question and answer section. So the first question is there any CE credit for vets? So the answer is no. Tonight, we did not get this race certified. Maybe we should in the future, but we haven't done that. Brad also asked, can you define a 1.5 man practice? So when I say a practice is 1.5 to 2.5 FTE, what we're talking about is how many hours a week of veterinary coverage does a practice have? So a 1.5 doctor practice is going to probably have 60-ish hours a week of doctor coverage. A two-man practice or a 2 FTE practice will have about 80 hours. So on average, full-time is now sort of 35 hours for vets. So it's maybe 35 and 70, and a 1.5 would be, 62 and a half hour, 57 and a half hours. But that's the point. We're looking at sort of full-time equivalents for the veterinarians. So thanks for that question. I'm going to hold this Q&A open for another minute or three. Maybe I've been so thoughtful and specific that I've answered everyone's questions. I don't expect myself to be that clear, but hopefully we will start getting some more folks asking questions. So Pamela stepped up and says, are there good buyers for one doctor practices that gross 1.2 million 5 days per week, 6 hours a day? I would say that there are probably not corporate buyers for that practice unless the following exists. If you have a building with 3 to 4 exam rooms and you're in an amazingly good market like Dallas, Phoenix, Charlotte, there will be some folks who might take some risk in the right market with the right building. If you are one doctor practice and you have 2 exam rooms in an older building, not likely a buyer for that practice. That's corporate. We would direct you to go to a brokerage group that helps you sell doctor to doctor. So the key with one doctor practices that are producing $1.2 million, $1.4 million, $1.5 million is all around geography and building. We definitely have seen buyers take a little bit of risk. They'll do joint ventures typically with those doctors to mitigate the risk of that one doctor leaving. There's lots of structure that will come with that type of deal. And so, Pam, if you want to talk more about it, set up a time, but hopefully that's enough color for you. All right. Another question from Gary. What do you see as possible consideration of corporate buyers in the near future? Or what is the possible consolidation of corporate buyers in the near future? It's a really good question. My personal view on that is the following. A bunch of privately held companies are not likely to buy each other. So I'll use VetCor or Western Vet that have 300, 400, 500 clinics or 800 clinics in VetCor's case. They're unlikely to buy a 50 hospital group when they're privately held. And that's because I feel pretty confident that they'll say, hey, I can go out and buy 50 individual clinics that I want to buy versus buying that other consolidator. And they get the clinics that they want. And so I think the consolidation of the consolidators starts happening when we see public offerings and when there are public companies that are veterinary groups. So when NVA or VetCor or Southern Vet Partners decides to go public, and there are a few of them out there, they are much more likely to buy a 30 or 50 or 70 hospital group than when they're privately held. And that's just because of how public markets view those sorts of larger acquisitions. They view them more positively than the private equity investors. And so I think there's still 40 plus consolidators out there. I don't think that number diminishes in a material way for at least 2 to 3 years until you have a few public companies out there. So hopefully that helps on that question. Next question from Brad again. Do y'all include practices that have dog resorts? The answer is yes. So the way to think about it is if the revenue from boarding and doggy daycare or boarding and grooming, if it's more than 15% of the revenue, then likely there'll be a discount on the multiple that you get. Meaning, a doggy daycare or a pet resort might typically trade at 5, 6, 7 times EBITDA, while the veterinary practice might trade at 10 or 11 times EBITDA. If the dog resort or the boarding stuff is a small piece of the pie, most buyers will ignore that and pay the full multiple. But if the resort is 25, 30% of revenue, you're going to sell them as a bundle, you'll likely see a little bit lower multiple on the practice, but it's totally sellable. So Sam then asks, what is an EBITDA that is too high? How much is the difference between your EBITDA and the buyer's EBITDA? So EBITDA is never too high. EBITDA margin can be too high, and I'll explain that in a second. The second part of the question is, how much is the difference between our EBITDA and a buyer's EBITDA? And that gets to a really important question. So if you're a DIY seller and doing it yourself, or working with I'm going to call it an inexperienced broker, you're going to be sending your financials to the buyer, and the buyer is going to determine what are the add backs and what your EBITDA is, and then make an offer. The reality is, if the buyer is doing the analysis, you're already starting in the wrong place. When we work with clients, the first thing we do is gather a whole slew of financial data, and we do an EBITDA and a normalized EBITDA analysis to figure out, what does your profitability look like if a corporate buyer had owned you for the last year? And we are then setting the benchmark of, here's how much EBITDA you have when we go solicit buyers. The buyers don't always agree with all of our add backs, but at least we've set the benchmark and we can have a negotiation with them, as opposed to them doing all the work. And so the most important thing from a seller's perspective is to really know what your business looks like, what its profitability is, and how a buyer will interpret your profitability. Whether you have 500,000, a million, or 3 million of EBITDA, no raw dollar amount of EBITDA is too high. What we have seen is, when your EBITDA margin, and EBITDA margin is defined as your profits divided by revenue. If your profit divided by revenue is over 28, 29%, buyers will tend to discount that EBITDA, because they've found that when they buy practices with that much EBITDA, EBITDA margin, they tend not to be able to sustain it. And so your EBITDA margin can be too high. If your EBITDA margin is 20 to 25%, that's amazing, and they're not going to view the buyers are not going to view that as having much upside. If your EBITDA margin is 15 to 20%, you'll likely get the highest multiple at that level, because buyers will say, hey, your margins are 17%. I know I can take it to 21 or 22%, so I'll pay a little bit of a premium for the right to be able to grow that practice, because they usually know that they can improve it in some ways. And so hopefully, Sam, that answers your question. It was a little long-winded, but very thoughtful questions there. All right. It feels like we are winding down, unless anyone else has questions. I appreciate everyone spending 50 minutes on a Tuesday night with me. Hopefully it's been informative. If you have further questions, don't hesitate to email me or call, and we appreciate your time. So thank you very much.